Ever wondered about those companies quietly thriving behind the scenes, the ones that touch your everyday life in surprising ways? What if I told you there's a company that makes your grandma's favorite pain relief cream, owns a famous aquarium, and holds significant stakes in some of the biggest banks? Today, we are pulling back the curtain on Haw Par Corporation, a Singapore-based multinational conglomerate that's been around since 1969. They're not your typical flashy tech stock, but their recent financial performance tells a fascinating story of resilience and strategic smarts. Welcome to Your Money Your Way YouTube channel. If you haven't already subscribed to our channel, please subscribe to our channel. Your support truly makes a difference, enabling us to produce more stock and fundamental analysis content. But first, a quick disclaimer. Please note that the content presented in this video is for informational purposes only and does not constitute investment advice. We strongly recommend that you seek proper guidance from a qualified financial advisor before making any investment decisions. So, what exactly does Haw Par do? They operate across three main segments, with a little bonus. Healthcare, this is probably where you know them best. They manufacture and distribute iconic topical analgesics like the globally recognized Tiger Balm and Quan Long brands. Tiger Balm alone is available in over 100 countries and is considered the world's leading topical analgesic. It's a powerhouse brand. Investments, this is where things get really interesting and, frankly, a bit unique. Haw Par holds strategic investments in major blue-chip companies like United Overseas Bank, UOL Group, and United Industrial Corporation. Think of these as their long-term, high-quality savings accounts, but on a massive corporate scale. Leisure. This segment primarily includes the underwater world Pattaya Oceanarium in Thailand. Yes, a literal aquarium. Property division. They also own and lease out commercial and industrial properties in Singapore and Malaysia. Here's the really compelling part. For the fiscal year ended December 31, 2024, financial year 2024, Haw Par reported a robust 5% growth in both earnings, hitting 228.3 million Singapore dollars, and total revenue, reaching 244.8 million Singapore dollars. Now, you might be thinking, that's great, but 2024 was a tough year, right? Persistent inflation, slowing economic growth. How did they pull that off? The secret sauce? It wasn't just Tiger Balm flying off the shelves. This growth was primarily propelled by higher investment income from those strategic holdings. Think of it like this: while their traditional operating businesses, like healthcare and leisure, felt the pinch of rising costs and geopolitical tensions, actually seeing a slight decline in operating profits, their massive investment portfolio was throwing off a steady, reliable stream of dividend income. This robust performance of the investment segment effectively compensated for and mitigated the operational headwinds. It's a brilliant example of a diversified business model providing inherent resilience. This makes Haw Par incredibly stable. Their financial health isn't solely dependent on how many tubes of Tiger Balm they sell or how many visitors go to the aquarium. That investment income acts as a critical and active capital reservoir, a stable funding source that gives them incredible financial flexibility. It's like having a deep well of cash that can be used to fund growth, make acquisitions, or pay out dividends, even when other parts of the business face challenges. And speaking of financial strength, Haw Par's balance sheet is nothing short of a fortress. I'm talking exceptionally strong. Their current ratio is an astonishing 31.38. Meaning they have over 31 times more short-term assets than short-term liabilities. That's outstanding liquidity. They maintained a substantial net cash position of 446.6 million Singapore dollars as of June 2024, and their total debt is minimal, with a debt-on-equity ratio of a mere 1%. This profound financial strength empowers Haw Par to self-fund significant growth initiatives, withstand severe economic downturns or operational shocks, and pursue opportunistic acquisitions without needing to raise external debt or equity. They can truly navigate challenges with ease and even capitalize on market opportunities when others can't. For income-focused investors, Haw Par also has a sweet track record. They declared a total dividend of $1.40 per share for financial year 2024. Get this, that's a massive 250% increase year-on-year from financial year 2023. And a big chunk of that, $1 per share, was a special dividend. What does a special dividend mean? It's a clear signal that the company has robust free cash flow generation and a strategic decision to return excess capital to shareholders. It shows management's confidence in the company's sustained financial health. They've even raised their dividend for 3 consecutive years. But what about the bumps in the road? Now, it's not all sunshine and roses. Even a diversified giant like Haw Par faces challenges. Operational margin pressures. Their core healthcare and leisure businesses are feeling the squeeze from rising operating and freight costs, exacerbated by global events like geopolitical conflicts. Also, a new healthcare production facility, while a long-term strategic move, is temporarily impacting gross margins due to initial excess capacity. Macroeconomic headwinds. They're exposed to persistent inflation, slowing economic growth, and shifts in central bank policies, all of which can affect their operations and the valuation of their investments. Limited analyst coverage. This is a noteworthy point for investors. There's not a lot of readily available analyst rating data for Haw Par. This can sometimes mean less market visibility and make it harder to find consensus perspectives on the company. Property competition. Specifically, their office building in Kuala Lumpur faces stiff competition from new developments and weaker demand. Who is Haw Par for? So, who might find Haw Par Corporation an interesting prospect? Long-term, value-oriented investors. If you're looking for a company with a super strong balance sheet, stable cash flows, and diversified assets that can weather economic cycles, this might be up your alley. Income-focused investors. The consistent dividends and recent special payout make it attractive if you prioritize regular income. Conservative investors. With minimal debt and substantial cash, it offers a higher degree of safety and capital preservation. Investors seeking diversified exposure. You get a mix of healthcare, financial services, through investments, and property all in one stock. Who might it be less suitable for? High-growth investors. While they have growth initiatives, their mature business segments might not deliver the rapid, exponential growth sought by aggressive growth investors. Investors seeking high liquidity. The stock's average trading volume is moderate, which might be a consideration for large institutional investors or those who need to trade frequently. Haw Par Corporation truly is a unique beast in the market. Its ability to grow earnings and revenue in 2024, despite a challenging economic environment, really highlights the strategic genius of its diversified business model and its significant investment portfolio. That fortress-like balance sheet and commitment to shareholder returns, like that hefty special dividend, are incredibly compelling. While they do face operational headwinds and macroeconomic risks, their strong brand equity in healthcare and disciplined financial management position them well to navigate future challenges. What do you think about Haw Par Corporation? Does their unique blend of old-school brand power and smart investing make them a compelling story for you? Let me know in the comments below. Don't forget to like this video, subscribe for more insights, and hit that notification bell so you don't miss our next deep dive. Thanks for watching, and I'll see you in the next one.